The third and final financial statement is the statement of cash flows. Like we spoke about earlier, this tracks the movements in your most important asset, your cash. Now, your statement of cash flows is generally segmented between these three sections: your cash from operating activities, your cash from investing activities, and your cash from financing activities. So like we spoke about, this statement, it's really just trying to tell you one thing: the movements in your cash. What contributed to your cash either going up or going down? Cash from operating activities represents first your net income, i.e. everything related to operating your business, i.e. your profit and loss, and all of the movements in your current assets and current liabilities. So that would be the net change in your prepaid expenses, or the net change in your accrued expenses, or your deferred revenue. Your cash from investing activities relates to the cash movements from amounts that the business invested in. Now, this is not the same as amounts invested into the business. That is a financing activity, which we'll talk about in a second. Cash from investing activities represents your purchases for your long-term assets. So like we spoke about earlier, if you purchase a piece of equipment or machinery or land or real estate or a copyright, all of these are assets that are going to give you long-term benefit. So the business invested in those activities, and it would showcase on the investing activities section of your statement of cash flows. And finally, we have cash from financing activities. This represents any amounts that was put into the business via creditors or the owners of the business, as well as any amounts that were repaid to either of those. So if you take out a loan, or if an investment firm puts money into your business, or let's say you repay that loan or return some of that capital, that would be a financing activity. Those are the three sections of the statement of cash flows. But another important note about the statement of cash flows is that it can be prepared under either of these two methods: the direct method or the indirect method. The direct method is really easy to understand, and it has descriptive lines such as cash paid to employees, or cash paid to vendors, or cash received from customers. It's really easy to read this statement, but it's generally very difficult to produce. The reason for that is you need a lot of additional information outside of what you'll find on your financial statements. The indirect method, on the other hand, is the opposite. It's not so intuitive to actually understand if you don't have an accounting background, but it's really easy to produce, and it generally looks like this. You really only need your profit and loss and balance sheet in order to prepare a statement of cash flows under the indirect method. And as we'll soon see when we cover the connections between these three financial statements, it becomes really easy to produce the statement of cash flows under the indirect method with just a profit and loss and just a balance sheet.